But I will go ahead and get started. It is already 9:05, so I know it's pretty late on the Eastern Seaboard. So thank you guys for joining us tonight. This week's weekly webinar is going to be pretty important, pretty imperative to day trading. There is quite an extensive amount of information that I kind of bundled up and generalized that I want to talk through today to really just grasp the whole concept of trying to figure out determining price targets, calculating stop losses, all based on an entry level that you may or may not know how to find yet. So I want to cover all those bases tonight in this webinar and answer any questions you guys have and try to help you out with figuring out all of this before that level, the entry level has been bypassed already. So I know that can be kind of a challenge sometimes, and I know it's tough, but it really makes or breaks the impulse and the emotional connection. Not trying to stop yourself from chasing stocks rather than determining an entry level at a certain point, a distance away. You have a solid trade plan built around it. And if you follow this plan, then the emotional aspect of trading and the chasing of stocks and the impulse buying will, for the most part, be eliminated. No, we're not calling out names. But yeah, like I said, so if you guys have questions, feel free to shoot them through this GoToMeeting link or through Discord. I'll have my phone open, and I'll be happy to stop and answer them. So here's my nice little cute intro page. I got my, I like to pump my social media. So you guys go follow us on social media, KF Investing. This is my pump time. So right there at the introduction, so I have everybody's attention, fresh faces. But like I said, today we're going to determine trade entry levels with price targets and stop losses. So it's going to bundle up, pretty much the entire trade plan system concept that will really ascend you to the next level from being an okay trader, a so-so trader, to maybe barely profitable or not profitable, to that next level to where you're starting to consistently see nice profits, tighter stop losses. So your losses begin to diminish and your profits begin to increase as you follow your trade plans on a more regular basis. And like I said, there's a ton of information here I wanted to compile into a sort of slideshow that can really grasp the general concepts that can fit everybody's criteria. So step one, the first thing we're going to talk about right off the bat is how to determine your entry based on what type of pattern that you're playing or what type of stock it is. And this is kind of a step 1, 2, 3 process. If you want to think about it that way, that makes it a little easier. So that's step 1. Step 2 would be to calculate your price target, and step 3 would be to calculate your stop loss. Now it's pretty simple. It looks pretty simple, and even on a slide, there's just 3 steps and that's it. But working through all these in conjunction, calculating all these in conjunction before that price level that you're entering on has passed. So it's really important that we can be able to do this quickly and efficiently while understanding the total amount of long-term benefits from actually having a trade plan. So step 1, right off the bat, we're talking about determine your entry. How to determine your entry. And that really depends on what type of trade it is. Now, the two most generalized trade patterns, and you can start going into subcategories if you want, but really you have either a breakout over critical resistance, or you're going to dip buy at support levels. And like I said, there are different types of subcategories, but at the end of the day, there's really 2 types of day trade plans. Now, it's important to separate the 2 because one, breakout over critical resistance, has a completely different set of categories or criteria in determining or calculating your price targets and stop losses. While dip buying at support levels will have a completely inverse effect or inverse way to calculate it. And it just really depends a lot on your individual risk tolerance, but we'll get to that later. But when you buy stocks on a breakout over critical resistance, your entry, and when you determine your entry should be one increment above that respective resistance level. And what I mean by one increment, I could have just said 1 penny, but anybody who trades penny stocks under $1 knows that sometimes the increments go from just 2 after the decimal point to maybe 4 places after the decimal point. So it might be 0.9999, and that would be an increment. So one increment above that would be 1.000. Usually you don't see this unless you are trading stocks that are traded under $1 in the sub $1 area. Usually for stocks above $1, it would just be $1.10 or $1.15 or whatever the case may be. But to really cover all the bases, I wanted to put one increment above because there are more increments. So if you wanted to buy above a critical resistance level on a sub $1 stock, let's say it's 50 cents. If the increment is 0.50000, you want to buy it at 0.5001, not 0.51, but 0.5001. It's not 1 penny in this case, it's one increment. So it's important to know that when you are buying above that resistance level, it does matter if there how many decimal, how many zeros there are, how many increments there are above that decimal place. Now, on the flip side of that, when you dip buy stocks, your entry should be on or above that critical support level, as opposed to a critical resistance level from last topic. Again, the increments do count here, but it's a little less important to really nail maybe a 4-digit increment here, because you're buying above or on, so you don't have to put it right above a resistance level. That's not the case here, because on these support levels, sometimes the price may not fall all the way down to that 0.00 increment, that whole cent increment or whole dollar increment. Let's say the support level is at $5. Sometimes as the price falls and it bounces off that support, the bounce doesn't have to come on right at that $5 level. It could come on 501 or 502. So sometimes, and you'll see this in the alerts, I would alert a dip buy at, let's say, 505 if I wanted to play the bounce off the $5 support level. And that's simply because the bounces off those support levels don't necessarily have to hit that whole 00, that whole dollar support level. It could be a bounce right above it and still be using that support level as the technical bounce. So the first one that I wanted to really dig into is the technical breakout. This is the most popular one. This is the one you see most of the time, especially with penny stocks who have high volatility and a lot of momentum trading penny stocks that could go parabolic with a low share float. Now again, I want to reiterate that entry should be one increment above that respective level. And on the chart to the right, you can see what I mean by that. The live alert that I posted on this stock on this given day was buying over $2, which means if I'm buying over $2, I'm buying one increment above that respective $2 level. So in this case, my entry would be 201. It's important to not buy it at 2, because 2 is part of that resistance. If you put your buy in at that $2 resistance, you're just going to get caught up in that bid wall of ask, and you want to make sure, and the whole play is based around the breakout above. So you want to make sure you get the closest entry you can above it, but not anywhere on it or under it, because that way you're just going to get yourself caught in your position, caught in a scenario where if it gets denied that resistance level, your shares along with the price action will reverse to the downside, and that's maybe stopping you out. Now with a technical breakout, you have a higher risk, but you have a higher reward ratio. And what I mean by that is when you set your price targets and stop losses, which we'll go about later in the presentation, you want to have a certain ratio. Like, for example, if you want a pretty standard profit or risk reward ratio is a 2-to-1 risk reward ratio, or maybe you have a 2 ratio reward to a 1 ratio risk. I mean, you're risking 10 cents, but your reward for your price target is 20 cents. Or maybe your reward for your price target is 50 cents and your risk is 25 cents. So that's a pretty common standard range, a 2 to 1 risk reward ratio. But with these breakouts, because of the higher risk, sometimes you may have to shift your risk reward ratio to maybe 1 to 1. So if you're risking 10 cents, you're still looking to get 10 cents. That's probably the lowest that you'll see anybody go that has a trade plan set up, because if it goes any lower, if it goes any tighter than 1 to 1, if you're risking more than you look to get out of that trade, then it's not going to be worth it, and I would recommend staying away from that. The bare minimum is a 1 to 1 risk reward ratio. Obviously, the higher reward ratio, the better. So if we use 2 to 1, 3 to 1, 4 to 1, the higher the reward to risk ratio, the better possibility of the upside, and the more confident you are in the trade. Now here we are using natural or technical resistance levels. Now natural resistance levels, for those of you who don't know, who are just psychological levels of resistance based on natural price levels. Like $2 is a natural level of resistance because it's a whole dollar level. Any type of increment that ends in 5 or 0 is also technically a natural resistance level. So if I wanted to buy this at 220 or 230, these are all natural resistance levels, 240 or maybe 225. If it ends in a 5 or a 0, you know that is also considered a natural resistance level. Now, technical resistance levels are based on the chart and the candles that you see historically through the chart, but can also be on a natural resistance level. So a technical resistance level can also be natural. Just because a level is at $2 doesn't mean it can't be technical as well. If that's where the chart was denied last time, and that's also critical or technical resistance as well as natural resistance. And it's also important to note here that technical resistance levels tend to be a little more critical and more significant because natural levels of resistance it's just that. It's just natural. It doesn't happen to have maybe a big ask wall or a load of short sellers who have their stop losses right above as compared to technical. And the location of this specific entry here, I said this before, but it's over that $2 resistance level. You can see what happens on the action here. As it breaks above $2, it kind of consolidates here, but you see it never breaks back below that $2 level. It actually uses as support in this case. And then you can see the big move higher. This is that breakout that I was referring to that has a high reward aspect to it. But on the flip side, we could look at charts that faked out over that $2 level, got shorted really heavily, and pushed back down. Now, technical breakouts for stocks that have a high upside it's going to come with volatility. It's going to come with maybe a higher spread, more risk. You're not going to trade a $100 stock for the technical breakout in a day trade unless you have a massive amount of shares. So penny stocks, is basically the best technical breakout type of stock you can buy, because the breakouts, a 10 cent, 20 cent breakout on a $1 stock is a very significant gain. But just as fast as it can rise, as quick as it can fall. And so that 10 or 20 cent gain could actually flip around, maybe on a heavily shorted stock to a 10 to 20 cent loss just as quick. So it's important to realize that even though there is a high reward potential here, there is also higher risk associated with it. So that's why earlier I was talking about the 1 to 1 risk reward ratio. That's about as bare minimum as it can get. And if you're looking at a stock and you want to trade it, and you've determined your entry level, let's say here it was over $2. If you're looking for a price target, it cannot be any lower than how much you're willing to risk. Again, this has a lot to do with your individual preference and how you like to tolerate your risk. But again, at the end of the day, I don't recommend your reward going any lower than your potential risk. One second, I'm going to turn this sound off so it won't interfere with the slideshow. And again, guys, if you guys have any questions, please message me through Discord or through this GoToMeeting app. Chris said, is there any way to judge how far a stock might run on the breakout? We are going to get to that when we get to the section on calculating the price target. I'm going to hit that area, but yeah, there's not really a way to judge how far the stock might run on that, because if we did that, we'd be guessing the top. And if we knew how to guess the top of a breakout, everybody would be rich. So it's especially difficult to determine how far a stock might go on a technical breakout, because the momentum and the volume is the sole beneficiaries of that push. And so maybe if the volume decreases, or maybe if it runs out of gas from being too vertical, you never know when it's going to turn around. And as soon as it gets pushed down, and if it can't hold a support level, then it will fall. But there's really no surefire way to tell how far a breakout will run. And because of that, that's why people experience going from a green trade to a red trade, because you just can't really accurately determine where the top of a stock's going to land. But for the second type of major generalized trade pattern or trade style is buying the dip. Buying the dip is personally my favorite way to go. However, today, as we saw with that, dip buying wasn't as effective as the technical breakouts above resistance. But that's going to happen sometimes, depending on the market conditions and the way that stocks are being played, and it's cyclical, and we have to adapt. But typically, on any given day, I would rather try to find a dip buy opportunity on an uptrending stock, just because that seems to be the most successful pattern over the long term, over the long run. So again, here, your entry level and how you determine it on a dip buy should be based on or above the chart's critical support level. Now again, you can use natural or technical support levels. So here on this specific stock we see to the right, the chart support level was at $99.25 level. That is the technical support level for that stock that we used the chart to base it off of. Now a natural support level, maybe $99.50, maybe $99 exactly, whole increments ending like that can still be used for a dip buy entry. In fact, I love buying the dip buy entry on whole dollar support levels like $99 in this case. This seems to be pretty significant breakouts and also pretty significant support bounces on whole dollar support levels, especially for dealing with penny stocks at that $1 level exactly, because you go from a sub $1 stock to breaking above that $1 price range. And even though every whole dollar support level or resistance level is natural, the $1 level is especially significant due to the psychology behind traders and momentum. That $1 level is especially psychological and can provide probably the most significant bounce off support or break above resistance. Now for the dip buy, you're lowering your risk. When you calculate your stop loss, which we'll get into in a minute, it actually generally has a lower risk associated with a dip buy, but also provides a lower reward. And the reason why it provides a lower reward is that you're buying it at the bottom of that chart, generally at the bottom of the chart off the support level. So as it falls, it's going to create these resistance levels on the way down. So when it comes back up, it's going to have to retest some candles, previous high candles to make higher highs and to continue to the upside. And so because of that, it generates these resistance points on the way down. So here on this chart to the right, we dip bought it at $99.25. Now it's going to have natural resistance at $99.50, $99.75, especially a significant resistance at 100. So you see there's a few different resistant points on the way back up that if it gets denied that resistance, it gets denied a higher high and will likely be rejected and head back to the downside. And so because of that, you don't want to expose your position to too many tests at those resistance levels. So you have to lower your reward ratio to compensate for the amount of resistance points you come across. Now, on the technical breakouts above resistance, especially at all-time highs, or especially on gap fills that break above resistance, typically it has less resistant points up to your price target other than natural levels. For here, we're going to, again, use natural or technical support levels. Both work. Again, here, technical support levels are usually more significant because they're fewer and farther between. And again, here, that this dip by here to the right, we use that 99.25 critical support level as that bounce off support level. We could use 99, we could use 99.50, but 99.25 was ultimately the chart support that we determined to be the safest based on that trade plan that given day with our stop loss and price target ratio. Gonzo, sorry, I just saw this. This may be a dumb question, but when you set your price target point, which I suppose is a resistance level, isn't a lot of buyers going to try and sell at that point to making it hard to sell? Or would it be better to sell a few points below that? This is very important. This is a very good question, actually. So the way that you play this, there's a few different options, and it really has a lot to do with how patient you are, how much risk you're willing to take on, and how big your position size is. Now, for example, on this chart here, let's use this because this is the technical breakout chart. If we bought over $2, our entry was 201 here, hypothetically, and let's say our price target was 220. If the resistance level is at 220, which is the natural level of resistance, the safest way to play it is to, if you have a price target of 220, sell it at 219 or 218, a few increments below that resistance level. That's the safest way to go. However, you can also sell it at 220 because when it approaches 220, going towards that resistance level, if it touches 220, there's going to be a momentum and a higher increase of momentum associated with that breakout already. We are buying above 2, has broken out, it's got momentum, it's heading towards that price target. When it reaches that either natural or technical resistance level of, let's say, 220 in this case, that wall of ask the momentum is going to start chipping away at it. Now, whether or not it breaks that is the question. And yes, there is a chance that if you put your sale at that resistance level, your shares may not be taken. But the momentum pushing it up to that resistance level, as it starts chipping away those asks, your shares are usually going to be taken because even though there's a massive amount of ask there, sellers there, the amount of volume on this low float parabolic runner in this case is gonna either A, break above your 220 resistance level, or B, take your shares but maybe still be denied. But you're right, Gonzo. This is a good question because if you do want to make sure that if you want to be conservative and make sure that you exit the position, selling a little bit lower, like 219, 218, will ensure that your shares are taken. Now, what happens naturally is that if that 220 level does start to get denied and it's becoming more apparent, lots of sellers will do the same thing as what you're asking here. They'll just bump their price target down to try to undercut people. And that's why you see that denial of that resistance level start to head back down, deny that resistance and start to retrace that to the downside because of this specific point. They're afraid their shares won't be taken, so they try to undercut the other sellers, thus moving the bulk of the demand or the bulk of the ask down one increment. And then rinse and repeat. Okay, well, my shares may not be taken at 219, so let me sell it at 218. And then you can start to see those asks pushing those bids back down. And that's why it does that. That's why it gets denied a resistance level like that. It's because sellers go through this exact same thought process and will try to undercut each other, eventually pushing those bids down. Again, if you want to be conservative, that's the way to go. But if let's say you're in half size, or maybe let's say you're in a smaller position size and you're comfortable and you want to be patient, and then you can put your price target maybe 3 or 4 cents above 220 to where you're anticipating a break above that resistance level, even for a small pop. Because if your shares are waiting at 223, 225 on that break at 220, as it pops over, it's likely to take your shares. It's more likely to take your shares than if you were sitting at 220. So really, at the end of the day, it just depends on your risk tolerance and how patient you want to be. If you want to be conservative, a couple cents below. If you're content with that resistance level, put it there. And if you want to be more patient, inherit a little more risk, then you would put it on maybe a few cents above in anticipation for a pop above that resistance. Does that answer your question, Gonzo? Nice. No problem, Gonzo. JB, I assume that this is why your price targets are A plus, example 220 plus, because you're watching the momentum. That's correct. 100% correct. And it's also, I want to make sure that it's 220 plus, because even though I may look for an exit at 220, you guys who are trading it with me may be in a half size position, maybe in a smaller size position, or may want to just try to risk a little more for a higher profit. That's all up to your individual preference. And so I put that 220 plus here, for example, just to let you know that if it does break above resistance, it should pop. And if depending on your position size, that's probably the smart thing to do. If I'm in half size, a lot of times you'll see me try to be patient with my position and let it try to break above 220 and pop above it into an area in which I can sell my shares into. But that's exactly why, because as the momentum starts to slow down and the ask and the sellers start to undercut each other and drive that price target or the price at that current moment down, and bringing some pressure on the bids. At that point, the momentum is shifting to the sell side, and so at that point it's 220 plus. But at this point, you want to go ahead and take profit. So that's why we had the position there based on that momentum. So the difference between the two on the breakouts and dip buys is that the breakouts on your price targets and stop losses offer higher reward ratios, but they require a wider stop loss range, because if you have a, let's say, 5% profit target or price target, 5% maybe 5 or 6 cents. But with some penny stocks that are very volatile, very spready, having a stop loss that's below 5%, maybe 2%, especially in pop and drops, there's a lot of intangible scenarios that would prevent you from reaching your price target. Maybe a pop and drop, maybe the volatility, whatever it may be, will take you out almost instantly. So having a wider stop loss range, maximum up to that 1-to-1 ratio of profit to loss or reward to risk ratio, that maximum 1-to-1 gives you a little more room for that stock to play around with the volatility and maybe pop over that resistance level and then drop under a little bit. You don't want to get stopped out on that. So maximizing that stop loss range will increase your risk. But again, that reward ratio could be very significant, and the gains could be lucrative. However, on the flip side, the dip buys offer lower reward ratios because of the resistance points ahead of it, but minimizes the risk with a tighter stop loss, because we're dip buying a stock at a support level for that support level bounce. So if it cracks below that support level, there is no reason to be in the stock, because our trade plan is based around that bounce off that support level. So upon a crack below that support level, there's no reason for us to be in it. We can have a tight stop loss sitting right under it, and just exit the trade and move on to the next trade while only losing a very minimal amount of money. So if we're dip buying a stock at the $5 support level, or we're dip buying it for that support bounce off the whole dollar support level, if it cracks below 5, well, there's no reason to be in the trade. So we have a stop loss maybe at 494 or 497, or whatever the case may be. It's going to be a lot tighter than if you're buying it over 5. Your stop loss would have to be a little bit lower, maybe 489, a few percent lower, just in case it drops down of the volatility or the spread gets in the way. We don't need to worry about the spread of volatility on a support buy, because if it cracks below, the trade plan's spoiled. So at this point, we're going to start moving on to the price target and stop loss section. But before I move on, I want to make sure we're all on the same page. Everybody is not lost yet, or if anybody has any questions, I want you guys to make sure that before we move on, I haven't lost anybody or nobody's confused. So is everybody okay? Does everybody have any questions at this point? Because if not, we'll move on. All right, so it looks like you're good. Okay, looks like everybody's good. So we'll move on. I just wanted to add this little section break in here just to make sure everybody, if they're taking notes, be able to find a spot, or if you guys have any questions before we move on, we could just throw them in here. But if everybody's good, I'll continue. Thanks, Pete. So on to the next part of the agenda. The next thing we need to do, and by the way, agenda 2 and 3, calculating price targets and calculating stop losses can go hand in hand. It's not like that's a set order. Once you get past determine the entry levels, once you get past that part, these two are interchangeable. Not one does have to go in front of the other. My professional presentation skills, JB, I really appreciate that. I really worked hard on this presentation. I really put some time into it because this is it's a more complex part and it's a more imperative part of trading. So I really wanted to display the points, very clear, and make sure I'm very organized in the way that I present this information because it is so important. So on to the next one. When we calculate the price target, again, we've already determined what type of trade it will be, but again, it goes hand in hand with determining that entry, because now that entry is used to calculate both the price target and stop losses. They kind of move in a fixed range of each other. And so once your entry's found, that's the hard part. This part is really almost like it's plugging in an algorithm based on your individual preferences. So again, when you're buying a stock in a breakout over critical resistance, your price target should be based on the next resistance level above or your personal percentage goal. And what I mean by personal percentage goal is, let's say you want to, on any given trade, you're looking to make 5% on that trade. But that's your personal percentage goal. So that would be, even though that percentage goal may not be as high as the next resistance, it may be under the next resistance, and that's fine. You still can use that personal percentage goal, or you can just use the very next resistance level to the top, critical resistance level above it, to use that as a price target area. And as we were talking earlier when Gonzo brought that up, a great point was, how do you sell your shares at that resistance level? That whole question is propped up by determining that price target or calculating price target at that resistance level. You don't want to have your price target above the next resistance level, unless obviously the next resistance level is 5 or 6 cents away, then there's not enough upside. But you don't want to put your price target above a resistance level unless, one, you're in a position size that make you feel comfortable and risking it, or two, the momentum is so strong that you just are totally sure that it's going to break above, and even then, it's still not as safe. Now, when you're dip buying stocks, the price target should be based on the next resistance level or on a risk-reward ratio that's preferable to you. For example, that 1-to-2 risk-reward ratio that we were talking about earlier, this is especially prevalent in dip buying stocks because the amount of resistance points above your support level would kind of deter you from trying to find a right price target. So you can use your personal percentage goal, which is a risk-reward ratio. Those are interchangeable terms, or the next resistance level if it's provided it gives enough upside. If the next resistance level is maybe 2% above your entry, then you're going to have to look towards more on the side of your personal percentage goal or risk-reward ratio. Now, ideally, you want to find stocks that next resistance level falls in a threshold that meets your personal percentage goal. and that kind of kills two birds with one stone. So if the next resistance level is on a 10% increase, and your personal goal is a 5% increase, you know that your personal goal is going to be hit first. And that's ideal. That's what you want to happen. You want your personal percentage goal or your risk reward ratio to be met before the next resistance level, if at all possible. Because the less amount of resistance points having to break, the higher probability of your trade being successful. So when you're looking for price targets, or if you're calculating for price targets and stop losses, be aware of your entry level compared to the next resistance or support level, and determine it. Is that resistance level or that support level higher than my personal percentage goal, or lower? So if it's lower, you know there's a higher risk associated with it. It may be denied that resistance level. It may never reach a personal percentage goal. So if your personal percentage goal is 5%, next resistance level is 2%, comes up to that 2% next highest resistance level, you know at that point, we've already determined that resistance level is there. Now you have to make a decision. Do you want to take profit there, lock in profit that's smaller but guaranteed, or would you rather inherit more risk, let that level try to be broken, and reach your price target? Now you can take away this decision by only playing stocks with an upside range that falls at your personal price or personal percentage goal before resistance level. That's ideal, and just what you want to look for. But sometimes that's not the case, and that's fine. You can play it two different ways. So when you're calculating the price target, there's different ranges that, there's a standard that of range on price targets, as well as stop losses that I like to go by if we're talking about personal percentage goals. Again, I want to note that this is your preference, and the ranges will vary based on your individual risk tolerance and your personal goals, depending on an intraday trade basis. But because that preference is so individualistic, I'm going to only display just the standards or the standard price targets that I like to look for. That's not based on a personal percentage. Now for the breakouts, you can see that I like the range between 5 and 10%. I like to look for at least 5% price target on the minimum side, and then upwards of 10% or more, obviously on the breakout on the maximized side. And the reason I want 5%, which is higher than the dip buy, is because I'm also risking more with the breakout. Remember, the volatility of penny stocks will stop you out quicker if you use the same stop loss percentage as a dip buy. So you have to lower your stop loss, widen that stop loss, risk more capital for that higher reward. And so you want to start out, give yourself a nice ratio, a nice price target around that 5% level. Now again, like me today, I was too stingy on some trades, and I could have took profit when but as it was being denied at a resistance level that was below my price target. That will happen. Once it does that, if it does start getting denied, don't be too stingy on that 5% price target. If it's a 4% and the momentum is starting to shift, go ahead and lock profits. That would be my recommendation, because it may not hold that support level, and it may just fall back down, and you go from a green trade that almost hit your price target to now a red trade that might stop you out. So, but I do like to look for a range between 5 and 10% on a technical breakout above resistance levels. And the reason that's so high, again, is because we are risking more capital on that trade. So it needs to at least equate to a 1-to-1 risk-reward ratio. Most times higher than that. That's the bare minimum. Right. So, and then a more advanced way to do it, and again, I wouldn't, if you're a beginner or if you're new, if you're just now starting out, this is not something that I'm saying that you should do every time, but Pete does bring me a point. You can sell half of your position in that stock at a resistance level or at a shift of momentum, just to go ahead and guarantee profits on at least half your position. So if a 5% pricing target on your stock is, let's say, 20 cents, well, if you're up 10 cents, 12 cents, 15 cents, you're not at your price target yet, but you're already nicely in the green on it. and the momentum starting to shift, volume starting to drop, if you sell half your position, you're locking in profits, guaranteed green trade on that half size position, and holding your second half or the remainder of your position for an anticipated move higher up to that price target or above your price target. Now, the benefits of selling a half size position like this is that you can be a little more patient because you're risking less capital. You have less capital in the game right now, or less skin in the game, because you've already locked in and received at least half that position generated profits. That also, on the stop loss, you can loosen the stop loss, let it go a little bit lower if you want, because that half size position, again, is guaranteed less risk. And so having only a half size position gives you more room to play. So if you do lower your stop loss, be sure to raise your price target to be in conjunction with your risk reward ratio that you had set up in the first place, if at all possible. But again, I want to stress that you shouldn't be stingy on this. I'm this way all the time. I try to get, if I have my bracket set up, which is a very good way to do this, if at 5% and it's moving nicely, heading to the upside, which is got seemingly strong momentum, I'm more likely to just hold it for that 5% bracket hit or that limit at my price target rather than just take profits on any sign of weakness. But you want to typically sell into strength if at all possible. I know it's not, I know it's not a guaranteed science. I know it's, it can be difficult. It's easier said than done. But the worst thing that can happen to a trader, both emotionally and mentally, is that they had a nice green trade that was somewhat close to, maybe right under the price target, that had momentum shift, reverse to the downside, and they either went to red or got stopped out. And a lot of times, and this happens to me too, if I'm in the green on the trade and it reverses to the downside, I'm more likely to hold it and hope for a bounce because I just saw that I had profits on the table that I didn't take. So emotionally, I'm more apt to hold on to it, thinking I can retest that level and maybe take profits there on a bounce there. Again, that's not always the case. It may happen like this, but that's not always the case and can typically get you stopped out or maybe have you holding a bag, hoping that it does reach that price level again. Now on the dip buy price target, and this is the same, we can also sell that half size position in the same concept, same scenario. But with the dip buy price target, because we have those numerous resistance points on the way back up from a bounce, there's likely going to be reversals to the downside. If it can't make higher high candles, that's a sure sign that the weakness is coming, and more shorts are going to probably be adding to their positions, so on and so forth, and can actually force it below that support level you bought the entry on and crack under it and actually stop you out. So it's important to really take advantage of the profits you have, and if it's reaching 2 or 3%, that's a really good dip buy or reward, because you're only risking maybe 1%, 2%, because you're only you're basing it off a specific bounce off the support level. But again, dip buys, if we nail a dip buy on a parabolic penny stock, it can, and shorts are covering, it can really get going, and it can actually retrace its way all the way back up to high day. We see it every single day. But for it to cross through and break above that many resistance points just decreases the likelihood and the probability as it continues up. So it's really, I really recommend staying safe with dip buy entries because of those resistance points. Be aware of the resistance points that stock gets to before it gets there, and that way that you can be prepared to sell it if it gets denied, or maybe depending on your risk tolerance, be ready for a natural pullback off that resistance, because stocks will naturally pull back off of a resistance level that's been denied. That happens commonly. It's just because sellers want to sell a position, thus driving the price down. However, it's considered natural because we see it every single day, and usually in a perfect world, the price falls, with a tolerable fall, consolidates maybe right under that resistance level, takes a breather, gains the momentum back, and then makes another test and another leg up above resistance levels. Those are natural pullbacks that, again, in a perfect world, go through that scenario. However, especially if it's a high shorted stock, or if there's a lot of short sellers through, particularly in that day due to a weak news catalyst, the support levels that it pulls back to may not hold and it may crack. So again, that's the whole disadvantage of not being able to call the top or not knowing when that run of momentum will end. But the high range that you want to look for in a dip buy, typically on a standard dip buy price target, is set 7%. So you're looking at between 3 and 7% for that price target, and 5 to 10% on a breakout. This is the standard that you can use on pretty much any. You can set these up in your brackets. You use this just as a standard profit loss bracket order, and then you can, at that point, adjust your brackets to fit your needs and your risk tolerance level. So these are just the standards that you can use to base off and make a nice base off your brackets, and then adjust it as you need. But yeah, this is what I usually have in my mind and my trade plans as I start to develop based on my entries at a dip buy or breakout level. Does that make sense for everybody? We're all on the same page? Nice, Pete. Give me 1 second, guys. All right. So the last part of the agenda, or the last step, and again, these are interchangeable, but the last step is to calculate your stop loss. And I typically calculate my stop loss first, even though if that's not necessary. I like to calculate my stop loss first because I want to know exactly how much risk I'm taking on by entering this trade, based off maybe the support levels, or maybe I'm using a certain percentage in my head. Let's say the maximum I want to lose in this trade is 5%. Well, where is that level on the chart compared to its natural resistance levels or natural support levels? So you want to calculate stop. Typically, I like to do it first. It makes it easier for me to decide whether or not it's even going to be worth the price target I'm looking at. And if it's not, then at that point, I would probably just not actually enter the trade at all. Which is important to note that even on the last step of this trade plan or calculation, we still should not be in the trade yet. We should not have entered the trade yet because we're still constructing a trade plan. So even though I've determined the entry, I've calculated the price target, if I calculate the stop loss based on a support level or a percentage level, if it's not going to provide enough upside for the risk, then it's not worth the trade. And because it's not worth the trade, I'm not going to even enter the trade at all, even though I've already done 95% of the work on this trade plan. And maybe it's not worth it because there's so much resistance levels to the upside that I doubt I can get the price target I want, or maybe the support levels are so far down that a stop loss under our support level would just be too great. And we know you have a maximum percentage loss in your head that you don't want to cross. And if that next lowest support level crosses that threshold of loss, then you know that there's pretty much no way you can set a stop loss within your personal goal of risk. And that's a clear indicator to not actually enter the trade. So again, I want to stress that even though we've done all of this, you still should not be in the trade yet because the trade plan hadn't been built. And it's not until the trade plan is completed and you've calculated everything that you would put your order in. This helps with impulse buying, emotional buying, momentum chasing, things like that. All this is eliminated with going through this process. And again, it's very quick. And you base it off your personal goals. You base it off support and resistance levels you see on the chart. But until you get all three of these aspects down, you shouldn't really be inside the trade yet. I know that plays happen quick, trade setups happen quick, but it's worth calculating these and having them in your head. For one, your confidence. For two, the actual risk-reward ratio that we live and die by. And by three, developing a system of sticking to a trade plan. And again, you'll see me preach about sticking to a trade plan more than anything else probably, because the trade plan, you live and die by the sword. And without the trade plan, you're just impulse buying or you're impulse selling, and then it starts to avalanche, snowball effect, and all of a sudden you're overwhelmed and you think you can't do anything. Pete, I'm not talking about you. All right, so again, when you calculate stop losses, it does matter. Just like the other two, it does matter what type of trade it is. I'm not going to go through the technical aspects of that breakout or dip buying again, but I do want to say that when you buy stocks on a breakout over critical resistance, your stop loss should be one increment under your next lowest critical support or at your personal percentage tolerance. So what I mean by one increment under your next lowest critical support is for the basically it's the same concept as while we're buying one increment over that resistance level. Now that support level, under that resistance level, your next closest support level should be the area that if it were to fall under your entry and head towards that support area should be your anticipated area of a bounce. It should bounce there, and if it does not bounce and price under it, your stop loss is tucked in right under that support level, and you can exit the trade with a managed risk with a tolerated loss. Now the problem gets to become, okay, if the resistance level is $5 and the next closest support level is $3, that's clearly too much risk. If you have a stop loss of $2.99, that's clearly too much risk. So the way to offset this is to have a personal percentage tolerance. Like, let's say my maximum tolerated risk per trade, I don't want to lose more than 5% of my capital in that trade. So if 5% is my maximum loss ratio, and this can vary, I would recommend no more than 5%, but again, this can vary based on your risk tolerance. If that's your personal percentage tolerance, then you have to find a natural level of support to base that personal percentage tolerance off of. So if mine's 5%, and let's say that's hanging around, I don't know, the 480, 470 level, we know that the natural support ends at a 5 or 0 increment. So now you're looking at 480, 475, 470. So based on your personal tolerance, you don't want to still put your stop loss one increment under that natural support level that falls within the threshold of your personal tolerance. So it doesn't the technical support doesn't have to be, even though it works out nicely, it doesn't not have to be within 5% or whatever your risk tolerance is. You can use a natural level of support to base it off of that personal percentage. Now, having said that, it's ideal to have a critical level of support to have your stop loss tucked in under, because those critical levels of support, for the same reason we did buy, is anticipated to bounce. So natural levels can still bounce, but technical, like I said earlier, more significant technical levels of support are anticipated to bounce. So if you have a technical support level that's critical, less than 5% away of your entry, it's the perfect setup to have a stop loss sitting tucked right under there. So if it cracks under that support, you get stopped out, but still within your threshold. It becomes more complicated and a little more complex when that support level is way down below your risk tolerance and you don't want to risk that much. That's when you have to go out and you have to calculate your own support level based off natural increments and then put a stop loss tucked it right under it. Now, when you dip buy stocks, this is easy. The stop loss should be just under your entry location or under your next low support level. Again, I want to stress that the reason we dip buy at support level is for anticipation of a bounce off that support. So there's no other reason other than that bounce to be in that trade setup. Knowing that, we can have a nice tight stop loss tucked in just a few cents under that support level to exit the trade at a very minimal loss if it does not hold and bounce off that level like we anticipate. So you can get away with a 1%, 2% loss on a dip buy off a support level based off that lower risk. Now again, the trade-off is to have that lower reward based off the resistance ahead. But again, that's that trade-off, and that's why I like dip buying, because I have a specific level I'm buying off of for a bounce. Anything under it, there's no reason for me to be in the trade, and I can just exit with a very, very minimal loss. And that's why, that's one of the safest ways to go. However, again, on the flip side, technical breakouts, that's a different story. That tends to get a little hairy, especially with support levels right under it. Now, with $1, $2 stocks, is your stop loss far enough away? It's got to be within that 1-to-1. And so all that confusion and all that calculation is null and void with dip buying stocks. You have one specific level you're buying off of. If it falls below, we exit. That's that. We move on. Pretty simple, and the calculation here is pretty easy. You doesn't have to, you don't have to calculate your personal percentage goal. And I think what confuses most traders, or what frustrates most traders, is that they see a critical level of support that they want to use as a stop loss under, but too far away. Maybe they end up losing 10, 12% on a trade because that lowest stop loss was, that just that far away. It's 10 or 12% down. Well, instead of tanking or waterfall or just completely blowing the trade, use your personal percentage goal tolerance to your advantage. Let's say 5%. Calculate what would a 5% loss be. At what level would a 5% loss be? And then once you find that level, now that we know that natural levels of support act as a support level for it to bounce, let's find the next closest natural support level. Let's say if it's 470, and we'll put stop loss 469, we can find that by calculating our personal percentage tolerance. If that stop loss falls within that tolerance level, we're using natural level support, and it takes away the risk of having that price, having your stop loss way below a technical support level. That's what the confusion is. If the stock falls down below my entry, where do I put my stop loss at? Find your personal percentage goal. If it's 5%, then calculate that from your entry. Find the next closest natural support level, and just tuck it in one penny or one increment below that, and that's your stop loss. Now we get to go into mental stop losses and hard stop losses, and that's kind of a different story based on the momentum and volatility. But the same concept applies. Your location of your stop loss should already be determined. And it's not until you've determined your entry, your price target, and your stop loss are you ready to actually trade or take the specific trade. Mike says, how much time does it normally take you to calculate or make a trade plan once you find the stock? You get faster with experience. It takes me very little time at this point, just because once you've done it a few times, it gets to be easier. And to simplify it, knowing the amount of capital you're putting into the trade, let's say that per trade you take $3,000, you risk $3,000. Well, that starting point can be used to calculate your personal percentage tolerance lost or reward ratio. If you personally want to look for 5% of that entry level for a gain of 5% or a loss of 2.5%, if that's your personal goal or your personal tolerance level, you just know that 3% of $5,000, that's the gain that I want. So I just put that at a 5% gain. And if it's 2% loss, you have that 2.5% of your $5,000 entry, and that's that's the price that you can put your stop loss under based on that natural level. Now you can set up brackets, Mike, and that's much easier. And it's basically the standard, the way that I enter all of my trades is you have these templates of bracket orders, and you can set your templates up based on your preferences. However high or low your risk tolerance is, and just have them set for default templates. Mine is set on a 10%, 5% basis, 10% price target, 5% stop loss basis. So for every time I want to go in and buy some shares of a stock, I have this brackets order already set up for me. And so at that point, once those brackets are there at that 10%, 5%, which is just my personal goal or percentage tolerance, then I can adjust based on the chart's support and resistance levels. But the key item there that speeds everything up and simplifies the process is having those brackets orders in your ThinkOrSwim or whatever platform you use. And if you don't know how to use bracket orders, KF has very detailed explanations on his YouTube channel of how to set bracket orders using limit orders, stop orders, buy orders. And he covers all of that in great detail on his YouTube videos. And so if you need help with that, I really would recommend checking that out, because it greatly reduces the time spent calculating this. Yeah, so Pete's right. ThinkOrSwim has a plethora of tools that you can use to simplify your process of day trading or make things easier for you to calculate percentages and things like that. So you can use a trend line tool, the line tool in your ThinkOrSwim, draw from point A to point B, and as you're drawing up, the data bar next to your trend line that moves along with that line will calculate that percentage from point A to point B for you. So if you're looking at entering a stock over $5, you can draw a trend line from that $5 level up to, let's say, $5.20 and determine that percentage gain. You can also do that on for a trend line, draw a trend line on the way down. It will determine the loss. You can do that as well. However, if you don't draw trend lines too often, you can just stick to the natural levels of support and resistance based off your brackets. I would recommend to anybody that day trades to have some sort of brackets set up based off your personal percentage tolerance or personal goals, because once you have those orders in, at least you know that calculation there is standard, and you're at your base calculation at that point. Once you've got those brackets in, then you can adjust based off the chart, and that cuts this time in half, or maybe even more than that. So it does get pretty easy to calculate these percentages, especially once you do it more often than you gain the experiences. It's actually, it may sound like this is a drawn out process, but the reason it looks like this is because I'm going into detail on each specific part of this, just so I can make sure that everybody doesn't get confused, and make sure that we all know that in conjunction with each other how they work. And if you miss the trade because you're calculating your profit or in loss ratio or your risk reward ratio, that's fine. There's going to be 1,001 trade opportunities or trade setups to take, and that trade opportunity would never be your last one. So it's okay to miss a trade setup or maybe a breakout, or what. It's okay to miss that trade due to calculating your trade plan and you just missed it, because I would rather you miss the trade because you were calculating a trade plan to stick to based off of your own personal goals than try to impulse buy because it's approaching that momentum or it's approaching that resistance or approaching that support level. At that point, if you're rushing to buy the stock at whatever level it is before you've set your brackets up and before you've calculated your price target and stop loss, that means you're impulse buying, or you're chasing, or you're emotionally buying or selling. And that's one of the main reasons why traders fail, is because they're not sticking to a trade plan. And trade plans can be compounded on each other to actually make you green even if you lose more than you win. Because if you have, let's say you make 5 trades, all with trade setups, all with brackets at 10%, 5%. Well, if you're 10% profits and 5% stop, if you make 5 trades, lose 3 of them, okay, but only win 2, look where you're at. Now you're in the green, because even though you lost 3 trades at that 5% stop, 5, 10, 15, you're down 15%. You only win the next 2 at 10% profit, 10, 20%. So now you're actually net up 5% even after losing more trades than you won. So it's very critical, and it works in conjunction with each other. You can really take away the money part of it, and if you stick to your trade plan execution and stick to your risk-reward ratios, you can actually lose more than you win. You can, depending on your profit, and depending on that ratio, you can lose maybe 2, 3, 4, 5 times, win just once or twice, and still be green. But that doesn't happen. That calculation doesn't happen, and those odds are not with you if you don't trade according to your trade plan. That's all thrown out the window if you impulse buy, and so that's why it's so crucial. It's so crucial to stay within the range of your profit, your calculated profit and loss ratio based on your personal goals. It just is. I really can't stress it, guys. I really can't, because on a day-to-day basis, I may lose 2, 3, 4 day trades in a row, but stick to these trade plans throughout, continue on with the same trade plan style, win the next 1 or 2, and still be in the green on the day, just because of that risk-reward ratio that you stick to within the realm of your trade plan. And that doesn't happen unless you go through all 3 steps of determining these 3 critical aspects of that trade plan. And without it, it's just going to really enhance the probability of an unsuccessful trade, an emotional imbalance mindset, lack of confidence. It's just an avalanche that any trader struggles with on a day-to-day basis. I know I struggle with it all the time, especially if I'm on a losing streak. But I know that sticking to the trade plan based off historical stats, based off your risk-reward ratio, historically, you don't have to win every single one of them to still be green. But you do have to win more than you lose if you impulse buy, or if you stick to, if you don't have a trade plan, you're going to have to win more than you lose, or else you won't be successful. But a trade plan setting each of these components up gives you the best chance to win based on the number of trades you take. And I know it sounds simple, but it's unbelievably crucial to get to this point. So for the stop loss area of this, again, you can calculate either price target or stop loss first. I typically look at the stop loss, but for the breakout stop loss range, 4 to 6% is safe. That's a safe stop loss. I don't typically like to go further than 5%, but again, a 4 to 6% range is pretty standard for the corresponding profit or price target ratio, because then you're looking at a price target ratio of at least 4 to 6% if you're on a one-to-one basis. So you don't want to really go any further than 5%, but 6% for some people who are okay with that amount of risk tolerance, that's that range you want to stick around. Again, these are based off personal preference and not based off the chart, because the chart, each individual chart's different. So we're trying to just generalizing this based off of a standard range. On the dip buy, again, you can see that even though we have a lower price target percentage on the dip buys, we also have a lower risk potential on your stop loss on your dip buys. We're only risking 2%, between 2 and 4% stop loss, and that's on a high. That's if you let it. That's if you let it ride. You don't typically. I would never even on a dip buy on a critical support level for that support level bounce. I wouldn't want to have a stop loss any higher than 4%. I'd like to keep my stop between 2 and 3%. With that, at that point, profit to loss ratio, it just only climbs as the price goes to the upside. Because if you have that 2% stop loss, every single time it heads to the upside and breaks above a resistance level, your risk reward ratio is just climbing. Your reward is just climbing while that ratio at 1 of risk is still stagnant. And so that's why dip buys are so special in the form that even though they can provide a lower reward, that stop loss, especially for beginners, is a nice way to introduce yourself into day trading, finding support levels, finding your own niche, and finding your comfort zone with that risk tolerance level. Dip buying is the way to go. I would recommend that for any beginner who is just now starting out. start out with dip buying that you have the ability to have a really tight stop loss, 1, 2, 3%, and that way if you do lose, you're playing a trade plan, you're getting the experience, and you're not losing 5, 10, 15%, blowing up your account right off the bat. So dip buying, especially for beginners, is the way to go. That's how I would recommend starting off, just because it is so easy. Yeah, because it's so easy to determine if you're wrong or right. It's so easy to determine whether or not the trade plan is spoiled. If it cracks below that one specific level, there's not much else you are really looking for in that stock. So there's really, in theory, no reason to crack below to that 4% stop loss, because at a 4% stop loss, it's already cracked well below that level, and there's really no need for you to be in the stock that long anyways. And so a tighter stop loss is definitely recommended. This is just kind of the typical range. So you can set up 2 templates, one for breakouts and 1 percentage. You can set up as many templates as you want, but I stick with one to make it easier for me, and this is just my personal preference. I stick with 1 percentage template, 10%, 5%. But then, as I was saying earlier, then you adjust based on the chart or based on the pattern. But the main thing is getting those brackets out into your limit order, and then being able to adjust just really speeds up the process. But I just keep one specific template based on percentages, that 10 and 5%, profit loss ratio. And then if it's a dip buy, I'll lower that price target down to right under resistance level, and I'll raise that support to right under that support level. But with active trader and ThinkOrSwim, it's just as easy as dragging your bracket up with your mouse. It takes seconds, and so that's why it just really reduces the time. But yeah, you could set up 2 templates if you wanted to, based on whatever technical pattern you want to trade. For me, I don't like to add any more onto the process than I have to. That's why I don't use indicators when I trade. I just strictly use the chart candles to read, because I like to simplify everything as much as possible. I want it to be as bare minimum, as easy to understand for me as possible, because the easier it is for me to understand, the more confident I am in it, and the less that could go wrong, in my opinion. So I just have that one template, 10, 5%, because again, we did mention this earlier, that more times than not, we're going to be seeing breakouts above resistance level, because we're playing news catalyst stocks that have high momentum heading to the upside, if you're trading long. And so because of that, because we're trading stocks with news catalysts with high momentum to the upside, more times than not, we're going to see the pattern of technical breakout more than the dip buy. And so because of that, I just have my template set up for that percentage of my personal risk. Now, if I only traded dip buys, if I only wanted to trade dip buys, my template would be a little bit lower, maybe a 5 to 2%, because more times than not, I'm going to dip buy it, and I'm only looking for a maximum of 5% or a maximum of 2% loss. That's just my personal preference, and that's why it's so important to play around with the brackets and play around with these calculations, just so you can kind of get a feel of what you're looking for in a trade and whether or not it's worth it. Now, if you calculate these stop losses and price targets, and your price target, if it's unreachable based on the stop loss that you're set, then there's no reason to enter the trade. It's just not within the range or the realm of your trade plan. If it doesn't fit inside your trade plan, then it's not an A+ setup for you. And so having this all together before you enter the trade is, again, so crucial. I want to express that. And that's, if you guys take anything from this webinar, you can just at least take the fact that having these trade plans based on these percentages on statistical evidence that we see, having these trade plans can give you the benefit, give you the advantage of not winning every single one, or actually maybe even losing more than you win and still being in the green. So that's going to wrap up the content part of the webinar. I know I've spent over an hour. I didn't want to run over an hour, but it's content that you guys, I felt that you guys really wanted to dig into, and I know a lot of people had questions, and I wanted to give time for questions, but if you guys don't have any questions, I'll wrap this up. If you do, I'll be happy to answer them now. And no questions are stupid questions or dumb questions. This is all part of figuring the process out. Chris said, kind of off topic, 1/4 position, half size, full size. What determines your position size? What determines each individual position size is the amount of trade capital, the total amount of trade capital you want to risk in that trade. So for every trade that you enter, you want to risk, let's say, $2,000. That's the total amount of capital that you're going to risk per trade. Well, that's your full position size, $2,000 worth of a stock. Now, whether that's 100 shares or 1,000 shares, that's how you determine your full position size. Now, half of that would be $1,000 worth of stock. And again, you can at that point determine if the price of the stock divided by your total amount of capital that you want to risk, and determine the shares at half size, so on and so forth. Does that make sense? Okay, yeah. So it's all based off your total allocated trading capital for that particular trade plan. You're welcome, Chris. Does anybody else have any questions or comments? It could be off topic if you want. That's fine. I'll be happy to answer any type of question. Pete, I appreciate it, man. Yeah, it is very important. This is very crucial stuff and can really take you to the next level of trading. Whether you're a beginner or you've been doing this for years, this type of content and really grasping the calculations and understanding that the trade plan has so many different intangible benefits to it other than just figuring out how much you're going to win or lose on a trade is really the key difference between somebody who maybe might blow their account after a year or somebody who can do this for a lifetime, for the long run. So yeah, this is extremely important, and I hope I did I was clear in the concepts that I was presenting, because it is so important. I do want you guys to succeed, and I do want the best for everyone here. So I do want to make sure that everyone's on the same page, and we all don't have any questions or are not confused on anything. He said, yeah, when I was saying me, because it used to be me. Well, everybody, I have not met one trader that does not or has not impulse bought or bought at the wrong times, bought at the top. It happens every single day. I mean, that's just how it is. That's the stock market. That's the name of the game. But the complexity of the stock market and everything going against you in the stock market, the best thing you can do for yourself is set these parameters up for yourself to give yourself the best chance of success. All right, guys. Well, if that's it, if you guys have no more questions, then I'm going to go ahead and wrap this up in the webinar. And feel free to message me after if you think of some questions, or maybe you just want to just to ask it privately. That's fine. But thank you guys so much for listening. Thank you guys for tuning in. I hope you enjoyed it. And like I said, I will be here bright and early tomorrow morning, ready to trade alongside you guys, and look forward to it. So I appreciate it, and everybody have a great night. And thanks for tuning in.